The kiddie tax in Chapter 3 is a tax imposed upon children, and the reason that this tax came about, which has a very interesting set of calculations in it, is designed to have to deter parents from transferring wealth to their children in an effort to reduce the family's tax obligation. So here we have a situation where a child has interest income, which is unearned income, and earned income from some employment. So we calculate first, in a series of steps, we first calculate the net unearned income, and that calculation is the child's interest income minus 1,050 minus the standard deduction of 1,050. And these numbers are given in the formula in the book. Well, then we arrive then at the 9,650 of net unearned income, and I have the calculations and explanations listed to the right. Next, we need to calculate the taxable income. And the taxable income then is going to be the child's interest income or unearned income plus the child's earned income minus the minimum or the lesser amount of 12,000 standard deduction for a single person, or $350 plus the child's earned income of $12,400. And in this case, the minimum of these two is $12,000, so we'll take $11,750, the child's interest income, plus the child's earned income of $12,400, and we'll deduct $12,000 to arrive at $12,150. After we calculate the taxable income then the next step is to calculate the earned taxable income, and that's calculated by taking the taxable income we just calculated and deduct from it the net unearned income of $9,650. So we wind up with the child's taxable income of $2,500. All right, so now we have some key intermediary calculations, which, by the way, are in the gray cells. So all intermediary calculations are in the gray cells. Data that's given to us are in the yellow or yellowish cells, and then the answer is given in the green cell below. All right, so we've calculated then some intermediary steps for net unearned income, taxable income, and earned taxable income. Now we need to determine the child's tax liability using this information. The first step in this two-step process of calculating the liability is to take the earned taxable income of $2,500, add $2,550, again that value of $2,550 is given in the formula in the text, and we multiply the sum of those two values by 10% or 0.1, and we wind up with 505. So that's the modified tax on the earned taxable income. The next calculation in this tax liability is the modified tax on the unearned income. All right, so the first step we'll take is calculate the bracket 1, which is using the estate and trust tax rate tables. We're going to calculate this first level, and that is going to be taxed at 24%. So we'll take the minimum then of the net unearned income, which is $9,650, or the $9,150, which is given in the tax table here. And the minimum of those two is, of course, the $9,150. And so we'll take $9,150 and subtract $2,550, and again that $2,550 is given in the tax table, the tax formula, excuse me. And so we'll take the $9,150 minus $2,550 and we'll multiply that by 24%. And this is very similar to calculating the marginal tax rate on regular income. And we wind up with a tax of $1,584. However, we still have more to tax because you may recall that the net unearned income is $9,650 up here. And that exceeds the $9,150 and sends us into the next level. So now we'll take the $9,650 and we'll deduct $9,150, which is the bottom end of this range. and that will multiply by the 35%. And once we make both of these calculations, then we have a tax at the bracket 2 level of $175. We'll add the two together, and that will be the modified tax on the unearned income. When we multiply all three together, that is to say the modified tax on earned taxable income and the modified tax on unearned taxable income, we wind up with a total tax liability for this child of $2,264. If you have any questions on this somewhat complex kiddie tax calculation where the child has both unearned and earned income, please let me know.